All right, welcome back again, students. I'm explaining class example 2. What I've done in this class example, I've changed the intentions from class example 1 so that you can see what will happen if the intention has changed in regard to each item and how you are going to treat them. Now, some of the figures have not changed, the ones that basically are in class example 1, but some have changed. You will notice a few. Now, let's start with the building. The building is still the same as that one on class example 1. On that date when the revaluation is done, the carrying value is 425 and it has uh, been revalued to 600,000. So if you remember in that example, it was 175, the revaluation. And still we've kept the building, the depreciation and the warranty at the same rate, meaning there is no deferred tax again in terms of this building. Now let's check the building in terms of the intention. What is the intention? Right, here we are saying the buildings will be sold in the foreseeable future. So that is this is the intention in terms of the buildings. Now let's look at the calculations. Now I've explained most of these columns in class example 1. The only thing that you need basically to be aware of when the intention has changed now, and the intention here is to sell the building. Now if you look at from this line here just across up to here, now this is what I need to explain, this 125. How do you go about doing it? Now the intention is to sell. If the intention is to sell, you ask yourself two questions. One, if I sell this building at 600,000, will I have a capital profit? Yes, you'll have a capital profit because the cost price is 500,000, right? But then capital profit goes with taxable capital gains, right? You'll see I've put it nicely in number 4 here, where the capital profit is 50 because I've lumped the taxable capital gain and the capital profit into one, because remember the capital profit is 100,000, but the taxable capital gain will be minus 50,000. So 100,000 plus the minus 50,000 will give me 50 net off. I've demonstrated that in the first video in class example 1. And then the next question will be, if I sell this asset at this amount, will I have a recoupment? Your tax value at that time is this one. So you are going to have a recoupment because the selling price of 600 is greater than 425, which is the tax value, right? But remember, you cannot recoup more than the cost price. So your selling price is 600, but you must limit it to the cost price of 500. So 500,000 minus the 425 gives me 75, which is this one here. Like I've said here, it says plus here 600,000, you must limit it to 500 minus 425, it gives us 75. Therefore, the total is 50,000, which will come from the capital profit side plus the recoupment, giving us 125. So that is the 125 that you see here, right? And I've already said you need to look at the part of 0 here using the opening balance before revaluation, and 125 after revaluation, then the movement is the one in the middle. Now you will notice that this 125 here, this 125 there, this one here, is not the same as the revaluation amount of 175. That is why I always say to you guys, start when you calculate the temporary differences, you start by calculating this amount. And then you compare it to the opening before the revaluation, which is 0. Then the movement, you use it as a balancing amount. Because it's not always the case that the revaluation will carry to the temporary differences line. It depends on the intention. It depends on the situation. If the intention was to keep this building, obviously we'll put 175 here. If the intention was to keep the building. But in this case, the intention is to sell. You start by calculating this figure. Then you compare to this one, the 0 here. And then the movement in the middle is your balancing amount. So obviously, after calculating this one, you'll multiply it by 30%. It will give you this 37,500. And then you'll do the same because this one here is 0, then the top one will be 0. So on both these sides, you'll then say, okay, now I've got this. Multiply by 30%, it gives me this 37. All right. Now, then we go to the year end just to also continue and test the whole thing. Now, at year end, if I can say to you sell, you'll sell it at this amount. Do you have a capital profit? Yes, 64,706 is the capital profit. Then you should have a taxable capital gains. Right, it should be 32,353, which is a minus. So if you minus the 64,706 and a minus 32,353, it will give you the 3253. So which I'm talking about this part here. Here what I've done is I've lumped the capital profit and the taxable capital gain into one, which is the quickest route to the answer. Right. Now, question number 1 I've answered at the end, that the amount I'm going to get from between capital profit and taxable capital gain, the net of the two is 32,353. Right. Then the next question is, if I sell at 564,706, will I have a recoupment? Yes, because my tax value, which is this one, is sitting at 400,000, this amount here. So I've got a selling price of 564,706, which is greater than this. Yes, it is recoupment, but I must limit this amount to the cost price, which is 500,000. I must limit it to this one. Right. Now you'll see here it says plus 564, which is the selling price. I must limit it to 500, the cost price, minus the tax value. It then gives me a recoupment of 100,000. Therefore, in total, I've got the 32 coming from capital profit and the 100 coming from the recoupment. My temporary differences will be 132,353, which are demonstrated here. Here's the 132. Now, what I will then do, I will say, okay, I know by year end I'm supposed to be at 132,353. But after the revaluation, I was sitting here. What is the difference between these two figures? Obviously, then it will give you the one in the middle. It will tell you that you must add 7,353. Then you multiply those values by the tax rate. Then you can get this one there, and then this one here. Right. That is how you're going to go about dealing with the buildings if the intention was to sell. Right. Now, if you look at the machinery now, the machinery, I've changed the gross replacement to 800,000 in this case so that you can see how do you go about doing it. Now, the first thing you do is, remember, the 800,000 must be compared to the 600. It's gross. And then what you need to do, since the 600,000 has been depreciated over for 2 years already, it's left with 3 years. What you need to do is to then depreciate the 800,000 in terms of the historical, because historical already has been depreciated for 2 years. So you need also to depreciate the 800,000 for 2 years. Right. Now let's do that. It's at 20% like you're seeing here. Right. So the 600,000 has been depreciated for 2 years, which is 240, giving us a carrying value of 360. So we need to do the same to this 800,000. Right. Now let's go there. Right, we are here. And the historical column will look basically like that. Now, what we need to do, let's look at this calculation. I think it's it's number 4. Let's look at number 4. I'm supposed to put number 4 here so that you can see which one I'm talking about. I'm talking about this figure here. This one here. Let's just make it bold so you can see. Alright, I'm talking about that number 4. Now, it's 800,000, which is the gross replacement value. Then I'm going to minus the depreciation for 2 years. Right, because I'm doing it the same way like this one here, where it's 600 already depreciated for 2 years. Then it will give me 480. This 480 now, it's what we call a net replacement. The 480 is net replacement now. Remember, 800,000 is gross, 480 is net replacement. Then I will compare it to the carrying value at that time, which is this one, 360, this one. So I will say 480 minus 360, the carrying value at that time, it tells me the revaluation is 120. Right, which is what we've put there. Right, then it takes the new carrying value to 480. If you divide 480 by 3, it will then give you 160. Right, 480 divided by 3, 160. And if you minus 160 from the 480, it will give you the carrying value of 320. Your revaluation is 120. If you divide the 120 by 3, the remaining useful life, which will give you 40 for that year, then 8 is the carrying amount. And then historically, you'll leave the asset as if there's no revaluation. Then you'll come to tax value. Your warranty is 150 a year, or sorry, per year, because 600,000 times 25% gives me 150. So you'll see it's 600,000 minus the 300,000, which is for 2 years, and then it leaves us with 300. And then the 150 is for this year, it leaves us with 150. Now, then we come to temporary differences. If I then compare the historical and your 300,000, it gives me 60 here, which is taxable. Then obviously if I started at 0 and then my closing by that time is this one, then the movement is 60. Right. I'll then multiply it by 30%, it will give me this one again, 0. Closing is this one. Then the movement is the one in the middle. So for some of you, the easiest step is once you've calculated this, then you multiply it by the tax rate, then it will give you this one. Right. Then you can do the opening and closing, because already you've got the opening of 0, the closing is 60 here, the opening is 0 here, the closing is 18, then the one in the middle you can get it. It's easy. Now, the intention when it comes to the machinery is that in this case we are saying the directors have decided in principle to continue using these machinery, so they're not selling them. Machinery and vehicles, they're keeping them. Now if you are keeping it, it's easy, because what you just do, you've calculated the revaluation here, right? The revaluation of 120 here, which is the same as this one that you see here. So we just, if the intention is to keep, take the value and put it here, multiply it by 30%, it gives you 36. So in that case, you can then use the method of saying opening plus movement equals to the closing. Okay. Then you can do the same under deferred tax, because you can then say, if you plug the 120 here, then it tells you that you started with 60. You are plugging 120 here, so you should be at 180 here. Right. Then you go on. Right. You go on with this, also this side. Right. Now, if you then look at the calculation as you go on, you will end up at that level, right? Now, this question becomes a bit of an easy one, because even if you check the same question using the intention to sell, it will still give you this 180. If the intention was to sell, it will still give you that 180. But in some, it doesn't work that easy, that it adds the same way. Right. Now, let me explain to you why do you have, for an example, this figure here is a debit. Now, look at it here. Your warranty is 150, and then your depreciation is 160. So if I say add back 160, it's positive, it won't have a bracket, and then I say minus warranty, the difference between the two becomes a temporary difference that is positive 10,000. If I'm using the income statement approach, I've demonstrated it in example 1. So that tells me that this one is deductible by 10,000, and it must create an asset. That is why it's 3,000 debit to that side. So you can see 180 minus 10 is 170, 54 minus 3 is 51. Right. Then we look at the motor vehicle. The motor vehicle, the figures given to us are still the same, except that what we've done, we've changed the net replacement amount. Now remember, net replacement, it means you take the 350, you compare it to this one, the 256, right? So 256 minus this 350 will give us the revaluation amount, right? It's the simplest one. Net replacement is always simpler than gross. Some people, I think, they get confused by gross revaluation method, but net replacement is one of the easiest in terms of the revaluation methods. Now, if you then look at the vehicle, the figures in terms of the vehicle here, you'll see if you say that 256 is this one, if you compare it to 350, it will give you this revaluation of 94, right? Then what you'll say 350, as you can see, number 1 times 20% gives you the 70, taking us to 280. The revaluation is 94. Multiply that by 20%, which is the depreciation, it will give you the 18,800. It will leave us with the closing balance of 75,200. Historically, we are doing this as if there was no revaluation. Then there's tax value. Tax value, you'll see that if it's 25%, it's 4 years, so it's 100,000 per year. For 2 years is that 200,000, leaving us with a tax value of 200. And then for this year, it's the 100,000, which is number it's written as number 2. Yes, it's a number 2, giving us by end of the year the tax value of 100,000. So the process in terms of the vehicle is more or less the same as the machinery. You compare 256 to 200,000, it gives you this one. Then you say opening is 0, my movement is the one in the middle, which is 56, this one. Then you multiply by the tax rate. Okay. Now your revaluation amount, because the intention is to keep, here's the revaluation, you plug it here as a whole, multiply by 30%, it will give you this one. Alright. Then we come to here. Now what I like is that this one is taxable. You see, it's different to the one that you saw under machinery, which was deductible. Now you can see the 100,000 is more than the 70, which is depreciation. 70 is depreciation in the total column. Under tax value, the 100,000, which is this one here, this one is warranty, which is more, and then this one is 70, which is less. If I do the income statement approach and I say add back depreciation, it means positive 70,000, the one in the total column. And then I say less wear and tear, it says minus 100,000. So the difference between 70, which is positive, and the minus 100,000, it is a minus 30,000. And if it's in a bracket, it means taxable. Taxable equals to liability. So you'll see here, taxable 30, liability of 9,000. Okay, now you'll see if you take 150 after revaluation plus your movement, which is this one, will give you 180. So the 45 plus the 9 will give us the 54. So then we are done in terms of the calculations. Now then we can move to the note as given to us here. You will then realize that in terms of this note, the buildings, as demonstrated here, they are still the same as the one that I showed in class example 1. And if you look at the machinery, it has basically changed a bit because this amount has changed, the 480. I've changed the gross replacement calculation. Then there's 160 here, the depreciation. But the note here, the note as you see it, you must read the figures from the calculations using the total column. That column that is written total. So it will give you the note as it is. Okay. And then always remember the easy marks that are coming below, these ones that are given to you in the question paper. Right, this figure you will get it by adding all the historical columns in your calculation. The final figures in your historical columns, you'll get the 844, 800. All right. And then we explain the note now. The first thing you do in this note, you plug your revaluation amounts here. All right. And then you put the transfers to deferred tax. The 37 has to do with the buildings. The 36 has to do with the machinery. The 28,200 has to do with the vehicle. I've showed you this the last time. I said you put this, your transfers to deferred tax is this one. Okay. And then for this one here, your revaluation is 120. Your transfers to deferred tax is this 36. And then you move to this one, it's 94. Your transfer to deferred tax is this 28,283. Right, that is what is happening in that note, which is this note here. Okay, now then the next step is the transfer to equity. Now remember what I said. I said transfer to equity, you can only do that only for the assets whereby the intention is to keep. In this example, machinery and vehicles, the intention is to keep them. So you can only do transfer to equity for those two. Now, the logic is that what they are saying to you is that if you revalue an asset and your intention is to keep it, how are you going to realize, or how are you going to end the revaluation? Through usage, because you are using it. You're going to enjoy now an asset which has got a higher value. And if it's got a higher value, it will have a higher depreciation than before if you are depreciating it. So your only benefit in terms of that will be accrued, or will accrue to you in relation to the usage. You'll keep using the asset. So now, how then do we get this thing? All right, you can, I'll show you using one. Let's use one here. Like I've shared, I've said before. Here's the 120. If you divide the 120 by 300, no, not 300, by 3, sorry, 120 divided by 3, it will give you 40, which is this one. Or you can compare the depreciation figures, which is 160 and 120, the same. this one or this one, they will still give us the 40. So in short, what they are saying 40,000 increase in depreciation was due to the increase in the value of the asset, or was due to revaluation, right? So now you'll see here all the assets that it's 120 divided by 3 gives you 40,000. Remember, I said these figures must be transferred after tax, because already the value, once you transfer to deferred tax, then you are left with values that are 70%. So your transfer will be 28,000 in this case to equity, and then the next one, which is it should be the vehicle, the second one. 94 times 20% is 18, which is this one, multiplied by 70% again. So the two are the ones that the intention is to keep. So those are the ones that will give rise to the transfer to equity. Right. Now, then you will see required 3. Now, required 3, every time I skip it because I want to show you how to break it down. I've showed you in class example 1, but I'll still repeat it now. Now, for now, I've got the NDR 246. I've got it. It's from here. Here's the 246. Once I'm done with this, then I can transfer it to here. Okay. Now, the deferred tax of 147, I can go to the calculations and say my deferred tax for this first one is 39,706. 39,706, I'm adding it to, and then you go down plus 51,000, which is this one. Alright, and then plus 54,000, which is this one. It gives me 144,706. So that 144,706 will be this one here, which is the same amount that we must show a breakdown for here. Right, and then for assets, the PPE, this one here, what you do is you go to this column here, you say 564,706, and then plus 320, which is this one, plus 280, which is this one. It gives me 1164,706. Here it is, 1164,706. Okay. Now, the figure that we must now entertain is the breakdown of the deferred tax, which is this one here. Required 3 is this one. Remember what I said? I said if you look at it here, if I compare historical to tax value, it will give me a 0. Right. If I then compare total to historical, but okay, in a nutshell, under buildings here, if wear and tear gives me 0, then that means the rest of the amount is due to revaluation, the 39,706. I've even tried to explain it there at the bottom that is due to the amount, as you see there, that is the capital profit minus taxable capital gain. You won't have You won't have what we call you'll have recoupment. Sorry, you'll have recoupment when it comes to the building. So by end of the year, you've got the taxable capital gains minus the capital profit. It's 32,352. Then plus the recoupment, which will also give you 100,000. So you'll remain with 132,353 in under temporary differences. 132,353 times 30. It can't be 50. This one here. This must be 30. This one here cannot be 50 because that's a tax rate. Multiply by the tax rate of 30. It will then give you 39,706. So buildings, everything that relates to deferred tax is revaluation because warranty is giving a 0. Right. And then you'll do the same process here. If you compare historical, the last figures you see under historical and the tax value, they give you 90,000 times 30%, that gives you 27. If you compare total, which is 320 minus 240, how much is that? 320 minus 240, that will give me 80,000. 80,000 times 30 gives me this 24. Right. If I add the 2, the 24 and the 27, they give me 51 under machinery, which is this one here. Right. Here's the 51 under machinery. Okay. Right. So now that is the 51 under machinery. And then you go to vehicle. The vehicle, if I compare the column historical, the last figures that I see under historical and tax value, multiplied it by 30%, that will give me that 31. And if I compare the total column to 80 minus 204 in the historical column, multiply by the tax rate, it gives me 22. If I add 22,560 plus 31,440, it gives me 54, which is this 54 here. Right. Now, if you add everything in the column warranty, it gives you 58. If you add everything in the column revaluation, it gives you 86,266. And that should then tie to this reconciliation here. So this reconciliation just explains to you that accelerated wear and tear is responsible for 58,000, and then the revaluation is responsible for 86,266 of the total deferred tax amount that you see in this exercise. So I hope this has assisted you, and you need to look at both examples, example 1 and example 2, in relation to the PPE. Thank you.